supply is absolutely from the copper side. There is not enough supply. Demand is significantly going to outstrip supply over the next decade, and that's not an easy fix.
Welcome back to Liberty and Finance. We're delighted to have this first-time guest. Teo Dechev is the CEO, President, and Director of Mundoro Capital. She joins us this first time this Wednesday, August 10th, 2022. Teo, thanks for coming on Liberty and Finance.
Thank you for the invitation.
I couldn't help myself because it was so delightful to meet you in person at the Rural Symposium on Natural Resource Investing in Boca Raton, Florida, just 2 weeks ago. I can't believe it's been 2 weeks already. We're still, recovering. But one of the things that you and I talked about at your booth was the amazing economic times that we find ourselves in. A lot of people can relate to that. It might be a good place for us to start. Our viewers are very familiar with the intrinsic value of, for example, copper, gold, and other metals that your company focuses on as a royalty company. But first, if we could just talk about this very unusual environment we find ourselves in with record inflation, highest in the last 41 years. People are seeing that affecting consumer prices. We've certainly talked with other companies that are being affected by high inflationary environment in terms of fuel, labor, repairs, operating costs of all kinds. And as we discussed, as a royalty company, you're not directly operating assets, but you're participating in a long-term financial relationship with companies who are operating those assets and who are being impacted directly by those inflationary costs. But you brought up to me something I hadn't thought about before, that those inflationary pressures that we're all facing can affect companies in different ways, not just increasing their operating costs. So maybe could we start there? And perhaps the first thing to do would just be to remind everyone, for a royalty company, what makes a royalty company different from a mining company, for example, so that people just have that clearly in their mind before we proceed on in.
Absolutely. So in terms of a royalty company, and there's, when you look at the spectrum of royalty companies, or companies that kind of fall under that banner, it's a subsegment of the kind of broader minerals sector. There are the senior companies, which are purchasing royalties from producing mines, and obviously receiving royalty payments in return for those purchases. So they're really utilizing their balance sheet very effectively to acquire those assets being the royalty from a producing mine. Then there's the mid-tiers, and mid-tiers tend to purchase royalties from development stage companies or smaller assets, because they're, smaller bite sizes in terms of what they can afford from their own balance sheets. And sometimes those assets are, in a development cycle, which means that, they're going through engineering. Some of them might be going through construction. They will certainly also be impacted by an inflationary environment, particularly right now. What we've seen in the industry is, engineering studies that were completed even just 2 years ago that may be updated today. There's inflationary pressures of even up to 25%. So they are having significant impacts. And then there's the junior royalty segment, and those were companies that I think commonly used phrase in the industry is royalty generators. So they are generating a royalty from an exploration portfolio. It's a very diverse marketplace in the junior space. So you really have to get to know those companies and what the business models are. But for example, for Mundoro, where we're really focused, so we're considered a junior royalty generator, and we go to parts of the world, and specifically mineral belts, where we feel there is more potential for copper porphyries to be discovered. So we will directly get, and the mechanism for getting a license from each different country, depends on the local regime. So in the United States, you're staking and applying through applications. In Eastern Europe, where we're also very active, there you're directly applying to the government. So we go out, we acquire these directly from the governments through applications, these mineral properties. We develop targets to test copper porphyry systems. And then we bring in senior partners. And once the senior partner is brought in, we start receiving cash payments. So if you think about what is exactly a royalty asset, it is some form of an asset, which can be a contractual obligation, which in the majority of the world where you can't kind of tie your royalty directly to the land, it's a contractual obligation of one party to pay another party a series of payments. And if you think about that, counterparty risk is significant. So the better quality counterparty you have, the less risk there is in that contract, and therefore you have a more stable royalty payment. And that is essentially, the business that we've developed over the last number of years. So we have direct assets of our own. We bring in partners. Those partners give us payments to participate in those assets. We also get payments by operating those assets directly. And then fundamentally, there's milestone payments and then the ultimate royalty when the assets go into production. So we as a junior, even though we deal with exclusively exploration stage assets, we're actually receiving payments from that portfolio from time zero, which is why we kind of sit more in the camp of a royalty company as opposed to a pure prospect generator. Really long-winded answer, but hopefully it gives the audience a real understanding of the diversity of those types of companies.
One thing that you mentioned just now that reminded me, because you mentioned it to me when we were talking together at the show, was that aspect of starting your revenue flow from day one at time zero, because that's not at all obvious for companies that are royalty companies of have royalties established with operating gold mining companies, that sort of thing, or copper mining companies. The prospects for revenue from those sometimes depend on results of actual metal mined and sold, and therefore then you get a split of the proceeds of the sold metal that came out of the mine. So that's way down the life cycle curve of a development and exploration, et cetera, of a mine. So the fact that you're starting to get cash royalty payments stream coming in from majors who may have, or partners who may have come in and entered in and established a relationship to be off-takers from you eventually, sounds like it's a big differentiator for the way that you get early revenue, recognize early revenue from these projects.
That is an extremely important point, and I'm glad that you've highlighted that and underlined it. I think when you look at the royalty model, and I used to be in equity research years and years ago. I was actually one of the first equity research analysts to cover a royalty company, which back in 1999 was Royal Gold, when it was still a junior back in those days. When you look at a traditional royalty company, it's a series of small payments. And certainly back then, particularly when it came with big assets in the United States, piling together royalties, they always came in very small slivers. So it was like 0.25% or it was 0.3%. And here you are as an analyst trying to model out what that future cash flow would look like. By themselves, each individual one don't always have large cash flow profiles, but when you layer them together in a portfolio fashion, not only does it give you diversification against any one thing going wrong with one asset, but it also creates that layered, what I call the cake effect of you actually being able to generate a really significant cash flow from a series of assets. And that's lucrative. They're usually very long lasting, depending on the size of asset, of course. So the bigger the partners that you have, the bigger the operations, the longer lasting those royalties. And then if you have a series of them, that's a very lucrative business model. And that's basically what we've been able to achieve with Mundoro, is that we have multiple partners with multiple programs. And this year we're going to be generating just over $1 million of cash from our portfolio. And we can see that growing and doubling over next year based on the LOIs that we have signed for the upcoming assets. So it takes a while to build out, but when it's built out, it's a really nice effect and has tremendous value for shareholders, because that company, they're not going to be going to you for equity financings to keep the lights on. It's those cash flow payments are actually going to be able to sustain the company and help rejuvenate the pipeline with even additional royalties.
We were talking at the show as well about the inflationary environment that we find ourselves in. At a household, at an individual level, people feel it as a pain, as a pinch. We had our cost of housing go up by 50%. We were preparing to relocate, still are, and one of the steps we did was we sold our home, are renting it back from the investor who bought our home from us, but we had our rent increased by 50% because his interest rate increased on his loan. And that was like, well, dang, we had a fixed interest loan. We had fixed costs before, and now we're in a variable cost environment. People are feeling the pinch in a lot of ways at a household level. How does an inflationary environment affect royalty companies like Mundoro?
The inflationary environment is definitely real. As I mentioned a little bit earlier, we do actually operate our assets with our partners. Now, obviously, the partners are 100% sole funding the operations. But what we can genuinely see is that in the services side of the operations, there are significant cost increases. So drilling company costs have gone up significantly. Assaying company costs have gone up significantly. Geophysical programs have gone up significantly. So, and obviously, human resources in terms of compensation has gone up significantly. We can see wage inflation, not just in the mineral sector, but in many, many sectors. And not to mention, there's also shortages. We have that double effect in the natural resources sector where we haven't had a really good, steady flow of young talent come into the industry. And as a result, not only do you have strong wage inflation, but you also have a lack of just individuals to take positions, which has been, kind of a major concern for most companies in the sector for the last 5 years. But having said that, the only bright spot of wage inflation is that young individuals will be wanting to gravitate to these programs because I just recently saw an engineering survey across all disciplines, and the mining sector has the highest pay for young graduates out of all the engineering sectors. So hopefully we will see the effect start to reverse in terms of talent, but inflation is definitely a factor. So all of these factors play into, how much money you can get into the ground, and what your, a common metric in the industry is dollars of discovery that it ultimately takes to make a discovery, and that cost is going to go up significantly. The other factor for operations, like you and I have just very briefly talked about, is that when energy costs increase significantly, companies, the time that they spend for care and maintenance on particular mines, they might spend a bit more time, and it might actually be more profitable to put the operation on more care and maintenance at that particular point in time, particularly if there's a dip in the commodity price, but inflation is really high. Putting an asset in longer maintenance cycles to perhaps work on things that you hadn't had time to work through on maintenance, that's probably going to come into play. That will affect, obviously, the supply figure, which then, will hopefully have an additional effect on reversing the commodity price as there'll be kind of more demand for a smaller supply. But all of those factors, they're tinkering, right? And any kind of major new disturbance in the industry just puts that entire cycle offside. And as we obviously have all read in the papers, supply is absolutely, from the copper side, there is not enough supply. Demand is significantly going to outstrip supply over the next decade, and that's not an easy fix. This industry is, it takes a long time to get a copper mine into production, and right now the rate of discovery is very slow. It's undercapitalized. Not a lot of people with that skill set out in the marketplace. A lot of training is required, and so we actually see an extremely healthy, from an investment point of view, attraction to the copper sector. Investors should be strongly considering it as an investment opportunity, because it is, for the first time in a very long time, the supply constraints will have significant impacts and create equity opportunities.
I want to get into that in a minute because it's not every company that we talked with that is both like copper and gold, which brings in some optionality there as well. Before we jump into that, I wanted to ask you about the other aspect that you brought up when we met in person that I had never thought of, which was that increased inflationary environment may drive operating companies to need to consider alternative sources of capitalization, which especially because we've talked to several banking analysts, former bank director Alistair MacLeod is one, and others who are talking about this environment that we're entering, which has been fairly free money for the last couple of years at least, maybe the longest period of that kind of thing in a long time. But now actually banks changing their posture that they're so highly geared and they're concerned about their exposure to potential recession, et cetera, that they're having to draw in their horns, as he says, and be more cautious about their lending. So if you've got an operating company that has ongoing capital intensive needs, the banking and the credit environment becoming tighter, then where do they turn? Where does an operating company turn? They simply don't want to stop their operation. They don't want to stop their growth plans. So where do they turn for financing? It sounds like that could play right into what the royalty companies can offer them as an alternative.
Absolutely. Royalty companies have become a really dependable alternative source of financing for development assets or operations that are looking for expansion capital where they don't necessarily perhaps want to go down the project finance route with the banks, or for whatever reason the credit facilities are maxed out and the banks don't want to increase the credit facilities. I mean, you're in an environment now where obviously interest rates are rising. That obviously rises for the banks just like it does for the ultimate borrowers because they're intermediary borrowers always. And then when operations become, when there's more debt servicing costs with operations, it'll obviously decrease your free cash flow. As your free cash flow decreases, it might trigger certain covenants, so you can't actually get any more debt financing for those assets or project financing. So the bank's hands may be tied in actually giving you more money. They just can't because you're not making enough free cash flow. So hence, looking at the royalty alternative space for financing is definitely a wonderful opportunity for a lot of the mid-tiers. Perhaps that the majors might not necessarily have that issue. Majors always have much more access to capital, but certainly on the mid-tier space, that's a wonderful opportunity. And perhaps there's assets out there that traditionally royalty companies haven't been able to really start that conversation, but now perhaps both parties may be incentivized. It is a very competitive marketplace, though. We tend to see quite a lot of royalty companies competing for similar assets. So it still is a very, very competitive marketplace for the royalty companies.
All right. So inflationary pressures could drive mining companies to turn more to royalty companies as a source of financing than to banks, for example. And yet it remains competitive in that, even though. Can we talk a minute about the macroeconomic environment that's driving this outsized demand? In fact, the interview we did with Keith Neumeyer and Rick Rule several months ago was entitled "Massive Metals Shortage Coming," because we talked about decades of neglect of exploration and development because of a lot of reasons, including just companies having to really tighten their belt to get through hard times, that sort of thing, as well as and just do the operations rather than exploration, which is always an initial cost investment. But that now you've got suddenly this green economy, the new economy, the whole push for electric vehicles, et cetera, being a big demand driver for additional supplies of copper and other metals as well. So your company focuses a lot on copper. And can you talk to us about that demand supply imbalance, where we're at right now and where you see that going in the next few years? Because strategic investors who are trying to position themselves now to be in the right place where they wish they had put themselves, a few years in the future, looking back at now, what should they know about the demand supply balance or imbalance in the metals space now and going forward?
Well, you have to really kind of look at commodities separately. So let's just kind of isolate the conversation to copper. So 60%, maybe even a little bit more, of global copper supply comes from porphyry mines and major porphyry mines. Those porphyry mines, there hasn't really been a lot of new copper porphyry mines on the major scale for a number of years. As a result, those assets, what happens is you have to start digging deeper. The deeper you go, the more expensive it becomes. And the reason for that is because you've got more waste that you need to mine out in order to get in. You may be blessed with wonderful structure where your deposit actually gets, higher grade at depth. But sometimes that just keeps you at kind of making sure that you're at the same profit level as opposed to losing profitability. There's increasing wage pressures, as you know. Water resources are an issue with a lot of copper mines. So location is obviously a huge factor. So all of these headwinds are against the current operating mines. And then when you look at, all right, so how are we going to replenish that? The world, as I've heard one executive say, is awash with low-grade copper porphyry mines, but it's those high-grade mines that are really the gems, and those are hard to find. And it's really those operations that are meeting most of that copper porphyry supply that we talk about in the copper market. Yes, there's sediment-hosted copper systems. That's probably another 20%, and then there's kind of smaller mines and operations that are the balance. So copper porphyry, sediment-hosted. So where in the world can you go where there is high-grade advanced assets with easy regulatory frameworks where you can get a copper deposit into production? Not a lot of places. And so it's what it's basically doing is that it's created such a rush into exploration, which is perfectly fed into our business model. We focus on copper porphyries. Now, Mother Nature does not create, pure copper porphyries. They always come with other elements, so which is why we say we're focused on copper and gold. A lot of the Eastern European porphyry portfolio has both copper and gold, and depending on where you're located, some are more copper rich, other might be more gold rich. But that supply constraint is real. It has real barriers. And when you think about what it's going to take in order to get the next copper porphyry mine into production, it's so much a more time frame required to get the assets into production that something has to give. Either the copper price is going to shoot up, and obviously that will affect demand, or demand is going to be significantly stifled. And it's not a great it's not great for governments or for industry to not have access to copper, especially if you have specific goals that if you say in North America, we want to have electric vehicles in, 50% of households. Well, how will you get that if you don't have enough copper for not only the batteries, but just the entire infrastructure required to power those vehicles? So it's, something needs to shift in the industry, and hopefully regulation will be part of that shift to recognize, in order to meet one strategic objective of a government mandate, get more electrification into the grid, then they need to change the regulatory environment. The other is governments don't invest in copper exploration. So companies are really taking the lead in terms of more copper exploration. But we just talked about, there's less and less people in this industry. So you have, a good 5-10 years by the time you can train the new generation of geologists that are going out into the field. What are they looking for? What do they need to keep an eye out for? Who are the senior geologists that are going to be guiding those programs? There's a lot of team-based effort in exploration, a lot of geoscientists, geologists, geophysicists, metallurgists. It takes and permitting experts. There's a very multidisciplinary approach. So again, you can see more and more barriers for exploration to be really effective, to find these high-grade copper porphyry scenarios that can really have an impact on that supply need.
Well, there's so many topics we could delve into from here. I mean, one thing that we'll have to probably cover in a future chat would be about the management team that's able to demonstrate a track record of doing exactly what you just said and finding those high grade opportunities and converting those into producing assets, whether it's a financial royalty asset or an actual operating mine. Another was something you mentioned a little while ago, which was the tendency in a high cost of operations environment for some companies to throttle back their, in other words, you go flat out operations if you can make a ton of profit because the metal that you're producing is going for a really high price and you can do it at a low cost. But when your costs become high and the metal prices aren't following yet, the temptation is to just start doing a bit more maintenance and that sort of thing. People have asked us on our channel for the last several years, with these shockingly low metal prices in many cases compared to previous nominal all-time highs or other asset classes that have just run away and the metals have been lagging. They've asked, well, why don't miners just not operate? Why don't they just refuse to produce at those prices? And it sounds like in some ways there are aspects of that where it just doesn't make good business sense to do flat out 100% run operations if your operating costs are going through the roof and your output prices you can get for your output aren't tracking along with that. But the one I wanted to focus on was something you mentioned about your layer cake of many resources, many assets that all can contribute incrementally to a significant revenue stream. And you mentioned about diversification, which can be many different things. It can be diversification across different metals, different geographies, and different geopolitical jurisdictions as well. We've certainly seen some concerning developments around the world. There's been hotspots popping up in every continent. You mentioned Eastern Europe. That's got to be pretty close to a hotspot that people have been keeping an eye on recently. How does that diversification of assets, as you've described it, help a company like yours to weather or reduce risk, which you brought up before? How do you judiciously reduce risk in an environment where there are these geopolitical hotspots that are occurring around the world?
I think it's a really great question, and I think it's a really important question to ask a lot of management teams. You can take the approach, and again, I remember this from my equity research days. So operating companies are required to diversify risk. So you want, multiple operations. You don't want to be to kind of simplify a one-trick pony. You want multiple assets in multiple jurisdictions because nothing ever goes exactly right. There's always going to be a problem. And that happens not just in the mineral sector, in any kind of business that you're running. So you want a management team that can manage and diversify some of that risk, but not diversify it so much that, you don't know what you're invested in anymore. So one of the ways to do that is obviously jurisdictions, be in multiple jurisdictions. There's this a lot of discussion around what is a safe jurisdiction versus what's not safe. And I think it's an overabused term. There is no perfect jurisdiction. Every jurisdiction goes through ups and downs. British Columbia was a very complicated and difficult place to work in back in the 90s, and yet it has significantly improved. And it has gotten a wonderful kind of community of explorers now and miners and developers. So things have drastically changed for this jurisdiction. When you look at Eastern Europe is a wonderful jurisdiction to work in if you understand how to operate there and then understand how to balance out those cycles of various governments. We have diversified, again, sticking to our core competency of that copper porphyry exploration, but in Eastern Europe, we're focused on the western portion of the Tethyan Belt, and specifically in Timok and in Panagurishta. And now we're also in the United States, in Arizona and New Mexico, where the Laramide Belt is an extremely important, let's call it jurisdiction, mineral belt for copper, not only exploration, but production. If you look at copper production in the Western Hemisphere and certainly in North America, you need to be in Arizona. You need to be in that jurisdiction. There are extremely valuable, long-term, large copper porphyry deposits, and we think there is wonderful opportunity for more discovery in that jurisdiction. So we manage kind of risk within our company to explore in, different jurisdictions. We also, have different partners. So if any one partner needs to pull out of a program, there's other partners involved. So that, again, you diversify your exposure to your counterparty. Obviously, we're focused on copper and gold, but that's primarily because of the nature of those particular types of deposits. So those three aspects are extremely important for us for diversification. And yet, when you look at some of the investment marketplace, companies are rewarded for being pure plays. So how many transactions have you seen where a company had multiple assets and then they spun out one, and then they spun out this, and so they've created 3 investment vehicles. And so there is one part of an investment community that says, I will diversify my own portfolio. I will decide where I put that capital, and I'll decide I'll put a little piece here in Eastern Europe, and I'll put a little piece in America, and maybe I'll put a little piece in Australia. Versus the other side of an investment thesis, which is, no, I want the company that I invest in to think about that and create that diversified portfolio for me to just participate in one entity that's already got the diversification. They don't have to actively manage it. It's kind of active versus passive management. And if you think about it, think about the proliferation of ETFs. That's the whole concept, right? They're diversifying that portfolio. So you as the investor don't have to come up with your own diversification approach. The ETF does that for you. And that's what we're essentially doing for our own investors and our own shareholders. We think about the risk coming up. We have a very kind of focused theme, which is copper in the world needs to grow. And we find those jurisdictions, we find the right partners when we diversify with multiple programs. And so we think we're a pretty great opportunity for investors in that respect.
We've got a lot more to talk about, but I think we're running out of time on this particular episode, so we're going to have to regroup. But I wanted to make sure that people, in addition to being able to have asked their questions in the live chat when we're having this video, also know that where they should reach out for more information about the company. Now, I have to mention that your company was one of those hand-selected by Rick Rule to be an exhibitor at the Rule Natural Resource Symposium. And that's something that means a lot to a lot of our viewers because we've had Rick on for about a decade here. And they've come to look to his sage advice, his decades of experience, his track record of success at having a sharp eye for not only companies' balance sheets, but their management teams and the way that they approach doing what they're doing. So the fact that your company has Rick's endorsement means a lot to all of us. But if they want to find out more specifically about your company, where should they go?
Well, they can reach out to us anytime. We're always happy to talk to investors and shareholders. So we have an email address that everyone can reach us at, which is info@mundoro.com. They can also call us at the office, and it goes directly to our cell phones. So that telephone number is 604-669-8055. And, it's very, very easy to get a hold of us, and just send us a question, and we're always happy to talk about and kind of walk you through what it is that we do and how we do it.
We'll put some information that you just mentioned in the description of this video. So if people need to go there, look in the description of this video, folks, you'll find how to reach out to Mundoro Capital. And Teo, it's been a delight having you here as a first-time guest. We hope this is not our last time and that we get to have you back, because I'm sure that our viewers will have a lot of questions to follow up on, because there's so many aspects to what you're talking about. The copper and gold story, the royalty opportunity, the value situation we find ourselves in right now with most natural resource companies being at a much more attractive price than they have been for years. There's just so many things that we need to circle back on with you, and just thank you for joining us here on Liberty and Finance. And if you had any final thoughts for our viewers before we let you go, this would be a great time.
Well, it's a very big marketplace. Do your due diligence, do your research, get to know the management teams. I'm always personally happy to speak to any shareholders, any investors. So don't be shy to reach out, and ask any questions. It's about building that rapport with the team and understanding their asset base. And I think if you do those two things, you're you're well ahead of most investors. As an equity research analyst, you get trained to ask good questions and really get to know management teams and the assets. So I encourage the same of all shareholders and investors.
Well, thank you again for joining us for the first time. On behalf of all of our viewers, glad to have you here on Liberty and Finance.
Absolutely. Thank you for the invitation.